Inflation is a silent thief. Imagine that you saved $10,000 in 2010 and left it in a savings account. By 2020, inflation had eroded more than $2,000 of your buying power, without you spending a dime. Today, I'm going to show you how to build a dividend growth portfolio that beats inflation. We will look at practical strategies, real examples, and concepts you can apply immediately. If you want your money to work harder than inflation, then this video is for you. Welcome to 7 Hills Equities, where we break down smart investing strategies for long-term wealth. By the end, you will know how to structure a dividend growth portfolio that increases your income year after year. Inflation averages between 2 and 4%, but it can spike much higher. If you rely only on savings accounts or low-interest bonds, your purchasing power declines every year. Imagine that same $10,000 invested in a dividend growth portfolio. Your wealth and your income would have grown every single year, keeping ahead of inflation and giving you more financial security. Dividend growth stocks solve this problem. They pay you regular cash dividends. They also increase those dividends year after year, often by more than the inflation rate. Later, we'll build a diversified portfolio across sectors that tend to keep paying through inflation. Take Johnson & Johnson as an example. The company has raised its dividend for 61 consecutive years. If you had invested $10,000 back in 2010, your first year's dividend income would have been about $250. If you let that same investment sit there, today that same investment went from $250 to producing over $400 per year without selling a single share due to dividend increases. Dividend growth is like an escalator that keeps rising while inflation tries to pull you down. History proves the point. During the high inflation years of the 1980s, dividend growth companies still provided positive real returns. During the tech bubble of the early 2000s, many growth stocks without dividends collapsed. Dividend growth stocks kept paying and even increasing their income. The lesson is simple. Dividend growth has been one of the most consistent long-term strategies for building wealth, even in volatile markets. Not every dividend stock is worth owning. You need to be selective. Look for companies with a long track record of consistent increases. We'll cover payout ratio, growth rate, cash flow, and debt next. Well, how do you build a dividend growth portfolio? Look for companies with a long track record of consistent increases. The dividend aristocrats have raised dividends for at least 25 years. The dividend kings have raised dividends for 50 years or more. Pay attention to payout ratios. A healthy payout ratio is usually between 40 and 60%. Next, consider the dividend growth rate itself. A company growing its dividend at 5% or more each year can double your income in about 15 years. Strong cash flow and low debt are also important signs that a company can continue rewarding shareholders. Consider AT&T versus Coca-Cola versus Microsoft. AT&T once had a yield of 7%, but later cut its dividend. Coca-Cola, on the other hand, has a smaller yield but decades of raises. Compare that to Microsoft, who grows dividends at double-digit rates. How each company pays their dividends can have significant long-term considerations. You need to consider balancing your portfolio across different sectors: consumer staples, healthcare, utilities. Technology and REITs can add income and diversification. Building this diversified portfolio can offer protection for years to come. Imagine you invest $50,000 across these areas with a 3.5% average yield. That gives you about $1,800 in dividends in your first year. With a 7% average growth rate, your annual income could rise to more than $3,500 in 10 years. Taxes also matter. Qualified dividends are taxed at lower rates, usually between 0 and 20%. Non-qualified dividends are taxed as regular income. Placing dividend growth stocks in tax-advantaged accounts like IRAs or 401(k)s shelters your income from yearly taxes. International stocks may be subject to foreign withholding taxes, which reduce your net income unless you claim credits. Dividend growth portfolios are also a powerful tool for retirement. One approach is to live off the dividends while reinvesting any extra. The safe withdrawal rate of the principal is usually 3 to 4%, but with rising annual dividends, you may not need to sell shares and tap into the principal at all. For example, a retiree with a $500,000 portfolio could cover $20,000 of annual expenses with a 4% withdrawal rate. With consistent dividend growth, that income rises automatically. Further, you can use Roth accounts for tax-free dividends, plan withdrawals. Over decades, small tax differences compound dramatically. Investors often make mistakes by chasing high yields or panicking during downturns. The reality is that dividend growth stocks tend to hold up better in recessions. Managing a dividend growth portfolio requires discipline but not constant trading. Once a year, review payout ratios, dividend growth rates, and sector allocation. Compounding is like a snowball rolling downhill. It grows as long as you do not touch it too much. Imagine you invest $10,000 with a 3% yield and an 8% dividend growth rate. Over 20 years, your annual dividend income could grow from $300 to more than $5,000 if all of the income is reinvested. The biggest mistakes to avoid are chasing yield, concentrating too heavily in one sector, ignoring inflation, and neglecting taxes. Dividend growth investing is not about collecting a paycheck today. It is about building a rising stream of income that beats inflation, grows with time, and compounds into real wealth. If this video was helpful, please like it and subscribe to 7 Hills Equities. We share strategies every week to help your money work harder than inflation and bring you closer to financial independence.